Portfolio Builder members, welcome to our Wednesday Trade Alert. We'll be closing out a SPY trade and preparing for our bond portfolio position to close out tomorrow. Quick review of our program and then we'll jump into our current Trade Alert results. Daily income trade alerts at noon Eastern, Monday through Friday. Here's our current capital allocation and schedule. 50% in equities, 40% in bonds, 10% in gold. Our target income per month is $750 per $75,000 invested. Now we have averaged closer to just over $1,000 a month. 100 shares of the SPY traded Monday, Wednesday, Friday, taking advantage of 3 option expirations per week. The Emerging Markets ETF traded on Tuesday with 200 shares at noon Eastern. And then to balance the portfolio, we have 200 shares in the 20-year Treasury TLT ETF traded on Thursday, and a buy and hold position currently in the Gold Miners ETF GDX. So again, the target income is approximately 1% per month, but our average return to date has been just under 1.5%. If we take a look at our results, you can see the 15% decline in December did not phase our portfolio. We made 1%. In January and February, 2.2 and 1.7. In March, April, May, and June, we had quite a winning streak despite market direction, 2.7, 1.2, 2.2, and 3.2% return. And I'd like to highlight that in May, when the market crashed 7%, we had a better than normal return of 2.2%. July, we had our only loss of negative 1%, trying to protect against a trade war breaking down. Then in August, it did break down. We returned 1.8%. The last 2 months have been very choppy, difficult markets. We still made a profit of 0.3% in each month. Our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement. Our goal is to generate income and safety, not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Call Dean for a free portfolio consultation right now if you're interested in joining our program, but you just want to learn more. He's available right now at 505-322-7515. And if you actually go into the description box, we have a lot of links that you can check out, including every update we've ever published, an application page to join our advisory, and a link to our track record, which we'll review in a moment. And if you are already a member and you'd like to stop paying an annual subscription, call Dean at 505-322-7515. If you do upgrade to a lifetime program, you'll never get billed again. And we're going to throw in 4 weeks free in our boot camp, which has a bonus trade alert every Friday. And these are trades you don't want to miss out on. A couple reminders, our paid webinar is today at 2 Eastern. And then our free webinar is tomorrow at 2 Eastern. Now in the free webinar, expect to learn a lot. I'm actually going to reveal part of our $10,000 boot camp in that Thursday webinar, the first module, the most important one, which I call the big picture. In our paid webinar, we'll be talking about more advanced topics, including what I expect will happen in the next few months in the markets. And also, please do us a favor, like this video, leave a comment below, and subscribe to our channel, and make sure to click the little bell so you can get the automatic notification of each daily video we publish. And we've got 9 people watching live right now. This is only available live to our paid group. So if you're getting this later because you're expired, it'll be after the market closes, and you can still see our results, get a great idea of how well our program is working. But really, if you want to get the best results, you need to join the program, get the trade alerts live, and start playing this with real money. That's when people go from just viewing to becoming a serious client of ours. We're now up to over 155 clients, and we've done this by just giving away the trades, proving the strategy works, providing outstanding value to our clients, and instead of having sales letters and all that junk, we just give you the product. So let's take a look at the trade alert today. And the headline for today's update was JPMorgan, Buffett hoarding cash and long-dated bonds? Wait a second, why is the stock market all-time highs? Here's a funny cartoon from Hedgeye, and you got the fear of missing out ready to pounce on the S&P 500, the little fish. So quite comical. The results, we'll take a look at the big macro picture, what's really driving the markets right now in a minute. Let's just review our trade alert today, and then we'll jump into that. The SPY traded from 307.54 from Monday to 307.05 today for a 49-cent loss on the underlying asset. Our option caller, which protects us from downside risks and also generates income from selling call options, went from a debit of 37 cents to a credit, this is a typo, of 27 cents for a 3-cent loss on the caller, bringing our net loss from Monday through Wednesday to 52 cents. That's the bad news. That was on 1,700 shares. The good news is that a position that has twice the size, 3,700 shares in the TLT, rose by 80 cents from yesterday to today. That brings our total portfolio up 2.2%. And in our portfolio, that's a gain of $2,900 in the past 24 hours. Now, I've really expanded our daily trade alert so you guys can get an extremely detailed review of how the program is positioned and performing every single day, the good, the bad, and the ugly. So let's take a look at our return. In the past 11 months, we've only closed out 1 month with a loss, and that was in July. And again, that was a precaution to protect against the trade war escalating. Now, we came out of July from the G20 meeting with Xi and Trump saying that they had a, guess what, farm deal that they're going to sign. Come August, there was no farm deal, and Trump blew his lid. He started raising tariffs. We got a huge sell-off in the markets. We inked out a nice 1.8% return. So if you're at all nervous about the stock market, you feel like you've had a good run, and you want to protect your nest egg now, that's who's really going to get the most value out of our program. Because we're not trying to outperform the S&P 500. That's for younger folks who don't mind sitting on 15% drawdowns like we had in December, or the 7% drawdowns we had in May and August. So you got to ask yourself, when's the next big drawdown coming? Why is JPMorgan almost doubling its long-dated bond portfolio? And why is Warren Buffett at an all-time high cash position? We'll look at some other things that should be making you nervous right now in a minute. Here's a look at our SPY bread and butter portfolio. It has averaged 1.02% over the past 11 months. And in November, it is currently up 1.1%. This is our favorite play because we can guard that position so carefully, taking advantage of 3 option expirations per week, Monday, Wednesday, and Friday. No other ETF in the world has that many option expirations, which makes it the ultimate retirement income vehicle for our strategy. Now, if we go down to the Tuesday trade, you can see it has actually returned 21.4% in the year of 2019, and it's done it with much less drawdown than the S&P 500. So we can see in December, the S&P 500 lost 15%. We only lost 4% in our portfolio. In May, when the stock market fell 7%, we only lost 1.3%. And in July, S&P 500 was up, but again, we were playing it safe. September was the worst loss in the Tuesday portfolio at negative 6%, mostly from some failed trades in oil and silver. But after that, we came up with 4% in October, and we're already up 2% in November from playing the emerging markets ETF. So that's our return, and it's an average of 1.47% per month over the past 11 months. Now this represents a much smaller piece of our portfolio, but it does add the risk we need at the right time in the right amount. Meanwhile, our bond portfolio has done very well. It's had only 3 losing months out of 11, but it's important because it acts as the protection we need to be long equities when they're at ridiculous valuations. We're now at a PE multiple of 18. And for it to go any higher would be absolute insanity. And it probably will if we don't get a major trade war escalation, because we have 80% of all central banks currently printing money and lowering interest rates. So as the money supply grows, stocks go up in value without any major collisions. So in our bond portfolio, we have averaged 1.18% per month over the past 11 months. We have a small drawdown in November, but as you get through our presentation, you'll see why we want to maintain risk in the long end of the Treasury market because of all the risk factors that are piling up right now. Meanwhile, our precious metals portfolio has had an insane return, 10% per month, and it's done this by taking on a lot of risk. Now, normally I don't like to be long precious metals or crypto, but we're in an environment where it makes a lot of sense. The central banks are lowering interest rates, printing money. The only ingredient you need now is some fear. So I do feel like we have quite a road ahead in the precious metals, probably around 2 years that we can get away with lowering interest rates and trying to prop up the huge bond bubble we're in. $266 trillion bond bubble. It's the biggest bubble of all time. It's much bigger than the stock market bubble or anything else. And so unless the Fed signals they'll be raising interest rates, and or we get a miracle recovery from China without massive credit creation, we're going to want to remain long precious metals even through periods of volatility. That's how you can gain these huge returns we've had. And this has been a mix of Bitcoin and gold over the past 11 months. We'll take a look at the track record if you want to in our webinar coming up Thursday. But if you want to go through each portfolio, just click this link in your email or go to the description box and you can find our track record. So the track record link's right here. It's all in the open. Every trade alert we've ever issued is open for the public to review right here on the updates tab. So we've got nothing to hide, complete transparency. Let's take a look at what today's trade alert is. The summary of the key macros that China has lowered a key lending rate and is starting to make some bond sales in the euro area. They're looking at investment in the Aramco IPO. So they're starting to spend again, which is important if we want to believe that China is trying to really come to some terms with the U.S. and follow its suit. Because the other side of the coin is that they may want to cause a recession by design to try to put pressure on the U.S. to not be so strict with this trade deal, these tariffs, these sanctions, all sorts of pressures we're putting onto China. Meanwhile, JPMorgan has increased its long duration portfolio by 50%. Warren Buffett has the largest cash pile in the world, and the Fed has dropped rates 3 times. Every time they've dropped rates, it's been because of a prediction of a recession. Now, and that's been like clockwork. Every time they start to drop rates, it was because they saw trouble ahead and they weren't able to protect the stock market from crashing. Now this time, they're actually starting up the quantitative easing before the crash has begun. Normally, they just lower interest rates and they do not issue quantitative easing until there's a massive panic. But if you listen to the interview, and for bootcamp members, your daily dump has a new interview from Jamie Dimon from yesterday and Ray Dalio. Very good interviews. Highly recommend you watch them. He's saying the repo fix, which is about $180 billion a day of credit, which is more money than Buffett's Berkshire Hathaway has. So it's a tremendous loss that's being hidden in the financial system right now. He's saying they have to come in and make a permanent fix for the repo market to stop having these spikes. So the liquidity in the financial system is dried up. We'll take a look at that. It's definitely something to be highly concerned about. Now, throw into the bag of concerns, China continues to drag its feet and demand more and more in the trade deal. So we got to ask, is a stock crash in the works on the next wave of bad news? When will a trade deal even happen? Now they're saying it's going to happen in December. Can the stock stay up at this elevated level without a trade deal in the next week, which is when we were promised it by November 15th? I'll skip through this. This is more for our email folks who don't get to see the video. Let's take a look at the current trade. So the narrative continues to be positive. We remain long stocks and bonds. I've been issuing a very tight option collar on the SPY, which has limited some of the upside move. We've been giving up around 30 to 40% of the upside move, but we've been able to capture these gains very safely. And while we do have a little bit of slow bleeding in our TLT position, I'm not worried at all. And we'll take a look at why any bad news will skyrocket the TLT higher. And what we're going to see is that really the Fed has to slowly drop these interest rates over the next 2 years and print a whole lot of money to try to protect the markets. If they don't, yields are going to spike, the bond market's going to collapse, and that will take the stock market down with it. So unless they really want that to happen, I think they'll do what they can, and that is to slowly lower interest rates, perhaps at a rate of every 90 days, or after each time tariffs create market chaos. So we remain optimistic in the short term in the stock market, but we know there's a whole lot of problems on the underlying. That's why it makes sense to sell the 309 call. This is closing out the previous trade, excuse me. So the previous trade, we had a 98% win on the call option that we sold, and our put option was about flat. Meanwhile, the SPY traded just slightly down, and so that's not a big deal. We're not going to win on the SPY every single trade, but we are up 1.1% already in November and remain long. Here's the new trade, 308 call and the 306 put. So we sold the call and we bought the put. This means we give up profits after the SPY goes above 308, which is no problem for me. My target with the trade deal in the phase one, depending on just what all is involved, is around a 315 to 330 in the SPY. Now, without a trade deal, we probably go back down below 300 and see where the market settles in after that. And it's looking like the trade deal is having some hiccups. Here's our risk profile. We can have a maximum loss of $1.05 per share because of our put option at the 306. We could have a maximum gain by Friday of 95 cents a share. So that's the trade alert for today. Let's take a look at some of the top news I've collected over the past 12 hours. We got 11 watching live. These are all paid members. Thanks for joining us. And if you want to say hello in the chat box, we'd love to hear from you. We'll jump into the top news next. Okay, so here's the highlights over the past 12 hours. And if you're in our boot camp, you're going to be getting a daily dump of about 5 videos I highlight that really get into more detail. So definitely watch those videos each day. And if you haven't joined our boot camp yet, call Dean. His phone number's in the description box once again. If you simply upgrade to a lifetime deal, you'll get 4 weeks of the boot camp for free thrown in. All right, JPMorgan Chase has pushed more than $130 billion of excess cash into long-dated bonds and cuts the amount of loans it holds, marking a major shift in how the largest U.S. bank by asset manages its enormous balance sheet. The move, which has seen the bank's bond portfolio increase by 50%, are prompted by capital rules that treat loans as riskier than bonds. It's incredible, said an executive at a large institutional investor. The scale of what JPMorgan is doing is mind-boggling. migrating out of cash into securities while loans are flat. This is also a clip from one of the Daily Dump Bootcamp videos we're releasing today. The global economy, as suggested by JPMorgan's business cycle indicators, is in a synchronized recovery for the first time in 6 months. That, combined with easing U.S.-China trade tensions, and, here's the highlight, 23 cuts in interest rates projected for central banks worldwide in the fourth quarter. So now we know why JPMorgan wants to own long-duration bonds. Their interest rates are the most volatile to these rate cuts. And so just some tiny cuts around the world can drive these bond prices on the long end to much better valuations. Makes sense. Here's a look at the bank reserves. And so they're saying their reserves are too small. They need closer to $2 trillion to operate, and they're pushing for a one-time injection to clear up their balance sheets of around $500 billion. So that's another thing. What can the Fed actually purchase from these primary dealers? There's only about 20 of these such primary dealers. Well, treasuries. So it's clear they're gearing up for the next round of QE. The repo madness reserves not enough. They're pushing these central banks to buy up their treasury bonds to free up their balance sheets to make the financial system work. So we've seen this just go from 1.9 trillion and now it's down towards 1.3 trillion, and overnight lending has frozen. Without this constant $180 billion loan overnight from the Fed, money markets would have collapsed. So that's what I think's happening. They are getting ready for the next wave up in the bond market, and then they're going to swap these out again to the Fed for massive profits. And this is another interesting chart from JPMorgan. And we can see every time the market starts to slow down, what do? More quantitative easing. And so the market has been ready to crash 2011, 2015, and then at the end of 2019. Or rather 2018, in the Christmas massacre. So what did they do to react to that? They continue to lower these rates, print money. But what's the catch? Well, they're running out of room to drop interest rates. We're at the range of 1.5 to 1.75. And so that gives them a limited distance to drop. Now, we did hear the Fed for the first time start talking about negative interest rates yesterday. So that could actually elongate this a bit longer. Shiller PE ratio is near all-time highs. The only time it's been worse was in the dot-com bubble. So stocks are surely highly priced. Here's some charts. I've got more screenshots below. Those were just the big highlights. Stock market has had quite a year. Can it maintain these high levels? With the trade deal, I would argue yes, because we have massive quantitative easing. But without a trade deal, with any kind of major fears or panics, once we see what's really behind this repo madness, that's causing the banks to be short to the tune of $180 billion a day, there could be some problems. Here's the TLT, which has also had quite a rally this year. And again, it's because the big picture is we're in a period of low interest, lowering interest rates, increasing the money supply, and inflation, at least by the Fed's metric, remains low. Now we'll look, clearly inflation's not low. So at some point they will need to jack up these rates, and that'll be our key, our trigger to reverse these predictions. Here's emerging markets. To get back to the 2016-15 highs, we need to go up towards 52, so we still have some runway on this position. But again, if we see the trade talks break down, we'll be ready to do the inverted option collar, which is the most clever way to profit from an asset by owning it, selling in the money call options, and then buying in the money put options. So if that is something that sounds new to you and interesting and you want to learn how to do well in a bear market in either the bonds or the stocks, join our webinar Thursday, because I will teach you exactly how to do the inverted option collar, which is the only safe way to bet down on these assets. GDX, again, it looks like we have a good 2 years of the central banks trying to slowly but surely drop rates, print money, and hope to God that the global recovery can come out of the ashes. So that's what they're hoping for. The effect of that is massive inflation, and that's why we want to be long gold. So until we get word that the central banks are going to start raising interest rates, or until we start to see a serious recovery that would allow the central banks to raise interest rates, then we want to be long gold. Meanwhile, to become very bearish in stocks, I'm skeptical until this ETF cracks. Now, this is not part of our portfolio, but it does represent the corporate buyback scheme that has been elevating stocks for the last several years. In fact, over the last 5 years, the corporations have put $5 trillion into stock buybacks. That's absolutely crazy. And this represents the interest they have to pay on those loans. So once this thing starts to tank, watch out for the stock market because that'll mean this corporate buyback scheme has come to an end. Now in our boot camp, we are getting ready to try to capture a huge gain in the VIX, the volatility index. This is not the actual product we're playing. So if you are a boot camp member, don't worry, that's not the exact ticker we're following. It's just the one that comes up in Seeking Alpha, but it's very correlated. And so volatility is getting towards record lows. There's a huge $2 trillion amount of capital that tries to push it down. And then once it gets too low, just like clockwork, it spikes. So expect for another call option on the VIX coming Friday for our boot camp members as we slowly build into that position. Now, this is what's crazy. Despite lowering interest rates 3 times this year in a very short amount of time, despite adding $180 billion of liquidity to the financial system with overnight repo, and despite $255 billion being added to the Fed's balance sheet just in the last 60 days, the dollar is still near all-time highs. So this just tells you the problems we have here are much less worse than around the globe. Now, also interesting is how much strength we've seen in the yuan against the dollar. This is the Chinese currency, and it is now right at that 7 exchange rate, which used to be the line in the sand that everyone said was going to be problematic. Now, part of this phase 1 trade deal is supposedly that the Chinese will peg their exchange rate and stop manipulating it to offset tariff costs. They've made a lot of promises over the last 30 years and have kept very few. So is this whole trade deal just something that they're using to buy time? Perhaps. Here's a look at that 5-year chart on their exchange rate, and you can see whenever they get into economic trouble, they devalue their currency and print a whole lot of money, and that's what just about everyone does, of course. And you can see, because of this very poor exchange rate, their economy is suffering. Back in 2015, it was considerably lower. Even at the start of this trade war in late 2017, it was significantly stronger. Now, gold's been just trading flat despite all this trade hope, and that's because we know the big picture. The central banks are trapped. They have so many obligations. They have to keep these rates slowly going lower so that the bond market doesn't have a revolt and run for the exit. So they really have no choice. They have to keep slowly lowering these interest rates, printing money, buying up bonds from the banks, and trying to avoid a spike in yields, because that would cause massive losses for everybody who's been speculating in bonds. So just to give you a little bit of a picture, 16 trillion in negative yielding bonds, Imagine if all of that money ran for the exit because they thought the central banks were going to stop protecting the bond market and allow rates to rise. It would collapse credit systems around the world. Here's the crude oil. The rise in crude perhaps put a little pressure on the TLT for us in the last few weeks. But we are having massive inventory builds. I think this will come down. Now we do have the Aramco IPO coming in, so maybe they'll try to push these prices a little bit higher during this. Now in our portfolio, we do take 2% of our gold position and put it into a 1% position in Bitcoin and a 1% position in Ethereum. And so the same methodology for predicting up or down on Bitcoin works just as well for gold, so we do remain long in these two positions. Okay, now I got a few more news highlights and we'll let you guys go for the day. Too soon, China's Xi is unwilling to rush phase 1 trade deals. Trump, stock markets, all three, hit another all-time and historic high yesterday. You're so lucky to have me as your president. Just kidding. Spend your money. He wants to get those GDP numbers up. Zero Hedge says if everyone spends their money, i.e. books a profit, the market would crash. Just some funny comments. Here's a look at the U.S. economy over the last several years in terms of the GDP. And we can see it's still looking healthy, but how is it creating this GDP? Is it doing it while reducing debt levels? Or is it doing it by increasing debt levels? And of course, we all know the answer to that. $1 trillion deficit this year. That's $1 trillion we're spending that we didn't collect from taxes. That's a whole lot of treasuries being issued per month. If the Fed stopped supporting the bond market, these yields would spike overnight and everybody would run for the exits in the bond market. So the Fed's trapped. As long as the governments are spending more than they make and the debt levels remain this high, they're in a predicament where it's either lower interest rates, print money, have the risk of rising inflation, or raise rates, fix the problem now, and we go into an immediate recession, perhaps even a Great Depression. And so we can look at that $984 billion deficit this year. It is growing at rapid pace. And here's a look at the repo. First it was going to be a 1-week fix, then a 2-week fix. Now they're going to push it to next year. Now we got JPMorgan saying, this is not enough. We need a permanent fix. And so they're talking around at least $500 billion injected into the primary dealers. And what can they buy with that? Mostly just treasuries. So makes sense that JPMorgan is loading up on long-dated bonds. Williams, inflation is contained near 2% objective if one ignores every single asset, of course. And we can look at the S&P 500 up 250%, high yield debt up 225 in Europe, U.S. high yield up 160%. Just everything is just skyrocketing in price. Everything except wages, of course. So it makes sense that we have protests all around the world. They artificially keep these CPI prints low. They let all the things we really spend money on rocket up in costs, like college education, medical, real estate. Here's the CPI index over a longer period of time. And you can see as soon as they got rid of the gold peg and came up with this whole central bank concept, which allowed the banks to basically bail themselves out on demand. Never have a losing bet. Must be nice. Well, we can see the CPI has skyrocketed. New day, old song. Asia shares race to 6-month high following new record highs for U.S. indexes on trade hopes. Trump administration debating whether to remove some existing tariffs. Yuan at highest since mid-August despite PBOC cut. Bond sell-off continues with U.S. Treasury at 1.8, gold at 1.5K, and Bitcoin at 9.3. The recession in the auto industry is tanking the global economy. If you listen to Daniel D. Booth, she likes to use the car industry as a leading indicator for the health, and it has been collapsing. There's huge parking lots full of used cars that will never be sold. Just massive, massive as they try to push new sales on new cars to keep this industry alive. Dear Federal Reserve, did you see that compensation per hour increased 4.5% year over year? Another data point for you to pretend does not exist as you keep cutting rates. Meanwhile, this may be one of the main causes of the repo madness. No one knows for sure. All we know is who are the primary dealers that can be bailed out with the repo madness, but what they do with the money after that is kept in the dark. After WeWork's disaster, SoftBank's Masa Son says bad judgment led to the first loss in a decade. Wait till credit collapses. This guy's going to be bankrupt, and all these so-called unicorns they've bought that do not generate profits are going to all go bankrupt as well. Look at WeWork, went from a $40 billion valuation to nearly bankrupt, now valued at $8 billion, and that's probably still highly, highly overvalued. SoftBank lost about $100 billion. China and France signed contracts totaling $15 billion during French President Emmanuel Macron's visit. So U.S. is out here doing tariffs with all of our trading partners. China is out handing out money to everyone. So that's interesting to see that they are starting to get the old purse out after being quite stingy over the past 12 months. China's blockbuster Euro bond sale just opened the floodgates. $4 billion. They're getting it at something around almost free interest rate, 0.5% in the Euro area. So we are seeing China start to expand its money supply, which would make me think perhaps they are willing to sign a deal and not just try to piss off Trump and get him to escalate again. But with that said, it would also make sense for the Chinese to try to put as much pressure as they possibly can on Trump leading into the election. So giving him a victory on a trade deal certainly would not help if they wanted to get him out of office. Chinese State Council, China to set up an infringement penalty system for intellectual property. Perhaps that's what they're talking about with this whole IP theft being built into phase one. In a stunning upset, Democrat Bashir is apparently the winner in the Kentucky government race, a blow to Trump, who was just out there rallying for him. Rand Paul says we need to subpoena the whistleblower. He may be involved in the corrupt Ukraine dealings. He was on the news this morning and part of your Boot Camp Daily Dump. House committee investigating President Donald Trump, this is from Bloomberg, released the impeachment testimony of U.S. Ambassador who says now he remembers there was quid pro quo. So slowly getting little pieces of this story. But I think unless this does go through the House impeachment for a vote and then goes to the Senate, I don't think we're going to see the full story because they are nitpicking little pieces of it and just leaking what they want into this public testimony. China's price for a partial trade deal with the U.S. is becoming clear. Beijing wants Trump to give up his favorite trade weapon, tariffs. Most severe internet outage to date hits Iraq after government blocks access. And there is some serious chaos around the world. If we think it's bad here in the U.S., it's far worse around the world as their incomes are low and the price of inflation is putting more and more pressure, causing protests all around the world. And this phenomenon is just going to get worse until there's a major shift of wealth and change a policy, which may not necessarily be good for what these folks are aiming for, but it's quite clear the big populist movement is going to gain control of these governments one by one and start making major changes, whether for the good or worse. And so we're seeing internet being blocked. There's probably a whole lot of violence happening right there. So that's a wrap for today's trade alert. Please call Dean right now. He'll give you a free portfolio consultation. 505-322-7515. We really appreciate everybody who's joined our program. And if you can help us out, like this video, subscribe to the channel. The best thing you can do is leave a comment. That really helps our rankings fly up and the organic results. And don't forget to subscribe to the channel.